Hello and welcome to this presentation. My name is Greg Klein with Hayes Financial Group, and we wanted to bring to you with this presentation some content because we realize that 2020 has been a pretty wild year, and this presentation is really to give you some food for thought so that if you've received at some point during this year or will potentially receive in the future a disturbing retirement account statement, we don't want it to cause you an excessive amount of grief. So we wanted to bring you this content on a better understanding of your retirement plan statement. And with that, let's go ahead and get started. On our agenda for the next roughly half an hour, we'll walk through the key sections of your statement. We'll start with where most of our eyes go immediately, which is right to the top line of our statement or your balance. Then we'll work our way into performance, which is another key area that we will focus on, and we'll give you some information so that you can digest performance more appropriately with your quarterly statement. We'll take a look at where your money is invested in your account or your allocation, see if there's any changes that need to be made there. Vesting, which is another word for ownership of those employer contributions in your account. We will discuss that. And then a couple of areas that may or may not be listed on your statement, like beneficiaries and lifetime income. And we'll give you some tips on those two topics as well. These snapshots in time can change. Account balances dip, and then they can recover at any moment, especially if we're investing heavily in the stock market. You'll see a lot bigger fluctuations, which is the nature of the beast and what a lot of us will do, because investing in the stock market offers us the most long-term growth. And we'll have a lot of our money invested in the stock market. So I always like to remind people that investing in the stock market, that the good times are more frequent and they last longer than the bad times. And that's extremely important to remember during the difficult times, especially like we saw at the beginning of 2020, or like we saw back in 2008. But if we look at the from the end of the quarter, so this happens to be the end of the first quarter, March 31st, 2020, after the market dipped down, it reached its low point on March 23rd. But you see some numbers here for a 100% stock portfolio and how much it was down over that first quarter, so for that first quarterly statement of the year. And then you'll see a portfolio that is a blend of 60% stocks, 40% bonds over on the right in the orange, or just strictly bonds, which are a lower risk type of investment. And you see they were actually still in positive territory. And then you can look not too much later, but we're talking about, essentially about a month later, and it's another snapshot in time, and it may give you a very different feeling. You see at the end of the first quarter where the stock portfolio was down 23+%, a month later it's down less than 12%, and you see the 60-40 portfolio down only about 5%. So thinking back to those emotions that you were going through at the beginning of 2020, and especially at the end of February, beginning of March, before that first statement came out at the end of March, you thought the sky was falling. But look at a month later, and even towards the end of 2020, things got back to positive territory. So you don't want to get caught up and trapped by those emotions during the difficult periods. It can turn around quickly. Remember, it is only a snapshot in time. And you see with this portfolio, even just a few weeks later, things look much, much better. So if you're getting close to retirement and you're in like a target date fund or a portfolio, this 60-40 split is going to be something like a target date fund that's close to retirement, or a more conservative portfolio. And where the market was down 25, 30, 34%, you see a blended portfolio like this was down, yes, in the double digits, but not for very long. May, it was back to just being down single digits, and then later in 2020 back into positive territory. So this also highlights the importance of diversification. But always keep in mind when you're opening a statement, or you're checking your account online, that it's just that snapshot in time, and it can change, and it can change quickly. It can go up just as quickly as it went down. So judge things more on the long term versus the short term. 3 months is very short term, which is a quarter of the period over which you'll receive a statement. That is not a long period of time. Any investment can be down over just 3 months. Knowing more about the benchmarks and what they represent, then you can understand why comparing an investment to the wrong benchmark offers us no help whatsoever. So just like comparing to your friend's account, it really doesn't do you any good. Comparing an investment in your portfolio to the wrong benchmark doesn't tell you anything. It's not an apples to apples comparison. Your investment may have gone up or down and been, in an inverse relationship to that benchmark, but it doesn't tell you anything if you're comparing apples to oranges. You want to compare apples to apples. So they put I put performance on the line of those different benchmarks that you'll see on this slide. And you can see the broad range you're looking at. These are year to date, so up through, into the spring of 2020. And you can see how, different it's been even for the large company indexes from, Dow Jones to the different Russell indexes, Russell growth versus Russell value. 2020 has been a much better year for those growth stocks. And then some of the smaller and medium-sized companies, you'll see bonds are positive territory. Again, they're lower risk type of investments, and then how the international performance has been so far year to date. But if you're not doing this sort of comparison behind the scenes, then, if you're not doing it on your own, you're only paying attention to a certain part of your statement, then there will be, advisors that will be doing this for you. So I'd like to remind people that, with your plans, you have an investment committee in your employer that's doing this type of monitoring. So if you're not the type of individual that gets down into this much detail on your own, it is happening for you on a retirement plan level. So this is being done to gauge the investments in your plan to these different benchmarks. But you may want to do it on an individual basis to see if an investment has outperformed, underperformed. You want to, compare it to the benchmark to really determine if that performance is true, if the investment made money for you, or compare it to the appropriate benchmark to see if your particular investment or that entire segment of the market did well over a specific period of time. But important to do that apples to apples comparison. We want you to know how to use this appropriately when evaluating your portfolio and your investments. And then you want to take into consideration again the time frame. Your investments, might lag the benchmark and have worse performance in one quarter. That's totally normal. They're not always going to beat the benchmark. But if your investment's lagging that benchmark over an extended period of time, first of all, then the advisors for your plan and your investment committee is going to flag that and look to potentially change that investment. But that might be something that you want to do on your in your individual account as well. So now you understand this comparison and how this is being done behind the scenes, how you can do this on your own to do that apples to apples comparison and compare your investments and your performance to an appropriate benchmark, and not so much to your friend or coworker or the wrong type of benchmark to give you the wrong understanding of how your investments have really performed in your retirement account. If performance of your individual funds is not compared directly to the benchmark on your statement, I can guarantee that it'll be on the fund fact sheets that you can find on your website for your retirement plan. You can go online and look at more detailed information on each individual investment, similar to the one that's on the screen right now with this performance. It's important to understand also what type of fund you're investing in, and because the funds, they'll compare it to different benchmarks, and then the performance relative to that benchmark, it'll vary depending on what type of fund you're invested in. So the first one that I have listed on the top of this slide is what they call an index fund. You'll see in this particular case, it says Fidelity 500 Index Fund. And I want you to understand that an index fund is what they call passive investing. That means it's simply going to track the benchmark or track the index that it's pegged to. This one again is that Standard & Poor's 500, or the S&P 500. And we now know from prior slides in this presentation that That's 500 of the largest US traded companies. And you'll see this index tracked almost perfectly by the Fidelity 500 Index Fund. You look at those performance numbers and they're almost identical over the short term, long term. And this investment in the S&P 500 index will be basically mirrored. Now, this type of passive investment is going to have a little bit lower cost because it's not trying to do better than that benchmark or not trying to do better than the index. It's just saying this type of passive index investment that just like the index, we'll invest in these 500 companies and we'll keep it simple and we'll track that index. But the other type of investment that you have available are what will be called, I should say, actively managed funds. So I have on the top passive and on the bottom active. And the fund that I have listed on the bottom of this slide is the Fidelity Small Cap Value Fund. It's being compared to that Russell 2000 value benchmark that I showed you previously. So this is actively managed where the managers of this fund are buying and selling stocks or bonds, whatever the type of investment is, and they're trying to outpace that index. So they're often a fraction more costly than a passive index type of investment, like the one in the top half of the slide. But they're strategizing to outperform the index or perhaps limit losses during difficult times. So they're actively managed. They're doing more activity to provide you that active management in the fund. And now that you understand, you're looking at performance. One might outperform the benchmark. One might track the benchmark exactly. It depends on if you're in a passive or an actively managed fund. That can make all the difference. So understand what the differences are between an active fund and an index fund. Now let's shift your focus from your account value. We've looked at balance and account value and performance, but I want you to think about unit accumulation or share accumulation in your account, which is what you're buying every time you make a deposit in your account. You're buying a little piece of a fund, so you buy some shares each time you make a deposit. And the value of these shares or units is what fluctuates every day with market performance. Your statement will detail this accumulation along the lines of what we've seen on this slide, and I think it helps to keep you motivated if you look at how many shares you're accumulating and not necessarily what the value of those shares are at any point in time. If you look at the increase in shares or units over time, irrespective of what happens with the account value, of course, we want to focus on the account value. That's very important, but understand that all that is that snapshot in time. It's what it would be worth if you sold all those units or shares at that particular moment. So whether account value goes up or down, you're always accumulating shares, and it helps keep you motivated because you're always buying more shares or more units each time you make a deposit. And here we can see, for instance, units held at the beginning and at the end of the quarter, and how many additional units that they acquired in their account, and if they had sold all the units or those shares, what that would be worth at the beginning compared to the end of the quarter. And you see now, if they had sold all those units, they have more units, but if they had sold them, they would have seen a loss. And they call that a paper loss because they didn't actually sell the units, so they haven't actually lost anything. They've actually accumulated more shares or more units. They're up to 532, almost 533 at the end of the quarter. Even though the value of those units is down, they haven't lost anything because they still hold those 532, almost 533 units. So it's just a paper loss. And so I think it helps to not simply focus on the value, because if you focus more on the shares or units, you're seeing that positive movement, that you're always accumulating more, and that's the name of the game, is just accumulation of shares, getting closer to your goal. and getting closer to achieving what you need for your retirement savings. Our next area to discuss is the difference between current and future money in the allocations of your retirement account money. So it'll be listed as future money, maybe investment elections, investment selections, and that's referring to the deposit. So any new dollars coming into your account, how they will be invested. Both future and current money will be shown typically as percentages. And you can see these two pie charts as the current money is the one on the right-hand side. And then how the money is actually invested, the investment elections or future contributions is the pie chart on the left-hand side. And they might be different, just like you see on this sample statement. The deposits are being invested 100% into one fund, but where the money that's currently in the account is diversified in a couple of different things. And that's totally fine. That's okay, as long as you understand why that is, and that's the way that you want it to be. This particular statement shows that this person is set up with an automatic rebalance or automatic realignment. So they will, at some point in the future, bring that current balance, the pie chart in the middle, back in line with their future deposits, the pie chart that you see on the left-hand side, and everything will be invested in that one age-appropriate fund. But I mean, I can say from experience, I've lost track of the number of times that I've helped employees through this sort of change where they thought both their future and current money were invested the same, and they went online to make a change and they only changed one of them and not both. So it's important to understand the difference. If they're different, that's okay, but we want you to understand why that is. If you do a type of automatic realignment or account realignment, it'll bring it back in line with however you'd like your account to be set up. That's an awesome feature. If you have that sort of option, use that, take advantage of that in your account. But just understand the difference between future deposits, investment elections, and then your current money, how things are divvied up currently in your account. And if there's a difference between those, understand why that is, and if you want it to be that way. If not, go ahead and make a change to fix it. Wrap up with a section that may or may not be shown in your statement, which is lifetime income. I have a couple of examples, one that shows all the details about how they came up with the projection as far as what this person would receive in lifetime income. And then another one down at the bottom that shows everything including 401k, Social Security, and explains how that's projected out. So you might see something like this on your statement. If you don't now, you also might in the near future, as there's been legislation that's pushing this forward and wanting people to understand how much their retirement savings is in terms of lifetime income. But if you don't get that on your statement, I put down at the bottom a website, immediateannuities.com. It's pretty easy. And in a couple of clicks, you can see if you turned your nest egg into lifetime income, what you'd be looking at as far as a monthly payment from that nest egg that you built up. A couple of screenshots of the website. I put in there $100,000 for a 67-year-old living in my state of Minnesota. So somebody that's eligible for full Social Security at 67. And they want to see how much a retirement would be if they turned it into a lifetime stream of income. And they're just looking at their own life. So an individual not have it based on this person's life and their spouse, but you can look at that. So this is just one individual. It's a male. He wants to know is $100,000, what it can buy me, and without any commitment, you can just a couple clicks and you can see that if this person turned that $100,000 into a lifetime annuity, they would get just over $500 a month. So you can use that sort of as a budgeting tool. You can think, am I on track? Is that going to be enough, included with what you might get from Social Security, to see if you have enough to pay the bills, keep the lights on in retirement, which is obviously the ultimate goal. Hopefully you have even more than that. But important to check on this, your Social Security. If you don't get your Social Security statement, make sure you go online. There's a My Social Security website that you can use to see how much that would be, and figure out what these lifetime sources of income will be for you in retirement. And that helps you be able to budget so that you know you have enough to actually call it quits and retire and pay for everything that you want to do in retirement. So immediateannuities.com, that's an easy website to go to for that sort of information.